Welcome to The Explainer. Today, we are going to be decoding one of the most revealing signals you can find on a price chart, the market gap. We're going to dig into what these empty spaces tell us about market momentum and, more importantly, how you can use them to build some really powerful trading strategies.
So have you ever been looking at a chart and seen a sudden jump? An empty space where it looks like no trading happened at all? Well, you've seen a gap. Today, we're going to explore those gaps and a special type called fair value gaps to uncover the powerful trading clues they give us, especially in the crypto markets, which, as you know, move lightning fast.
So, here's our game plan. We'll kick things off by defining what gaps actually are. Then we'll dive into the four main types you absolutely need to know. After that, we get to the good stuff, a step-by-step trading plan. We'll also cover the make-or-break role of risk in your own mindset, and we'll wrap it all up with the single most important takeaway. Okay, first things first, let's get clear on what we're looking for. It's really important to understand the two main forms of gaps you're going to see, because honestly, they tell very, very different stories about what the market is up to. So on one hand, you have your traditional gaps. You see these all the time in the stock market, which closes every night. Some big news can drop overnight, and boom, the price opens way above or below where it closed. But in the 24/7 world of crypto, we see something else more often, and it's called a fair value gap, or FVG. Now, this has nothing to do with market closures. It's a very specific three-candle pattern, where there's a literal gap between the wick of the first candle and the third. This whole thing shows a rapid, one-sided move, a liquidity void. And that right there is basically the footprint of big money pushing the price so fast that the market can't keep up. Now, you're going to hear this term all the time, filling the gap. All this means is that the price retraced, it went back to close that empty space on the chart. The thing is, some gaps fill really fast, while others might take forever to fill, if they ever do. And figuring out which is which, well, that's kind of the secret sauce. All right, so now we know what a gap is. Let's get a little more specific, because not all gaps are created equal, not by a long shot. If we can identify which of the four main types we're looking at, we can get a much better idea of what the market might be planning to do next. First up, we have the common gap. Honestly, you can just think of this as market noise. It's usually pretty small, it happens inside a sideways trading range, and it almost always gets filled pretty quickly. For most traders, these are not strong signals to trade. It's actually more important to just recognize them so you know to ignore them. Okay, next up is the breakaway gap. Now, this is a big deal. This happens when the price just explodes out of a key level, like a major resistance zone, and it's usually on a huge surge of volume. This often signals the very beginning of a powerful new trend, and it's a pattern that serious traders watch like a hawk. Then there's the continuation gap, which some people call a runaway gap. This one shows up right in the middle of a trend, and it's an incredibly powerful confirmation signal. It's basically the market shouting that conviction is high, more and more people are jumping on board, and the current trend has plenty of fuel left in the tank. And finally, we have the exhaustion gap. Now this one's a warning sign. It shows up late in a strong trend, often on one last big burst of volume, but then the price just stalls. It can't follow through. This is a huge signal that the trend is running out of steam and a major reversal could be right around the corner. So let's just put all that together in one place. Do you see the strategic shift here? For breakaway and continuation gaps, the plan is to trade with the momentum. But for an exhaustion gap, the strategy completely flips on its head. You're trading against it, betting on a reversal. And that, right there, is a crucial distinction to make. Okay, let's get to the most actionable part of this whole thing. Knowing the theory is great, right? But how do you actually build a real, repeatable trading plan around these patterns, especially that fair value gap we talked about? All right, here is a simple but really powerful setup for trading a fair value gap. Step 1, you spot that three-candle imbalance. Step 2, you mark the 50% level of that gap zone. That midpoint often acts like a magnet for price. Step 3, you plan your entry by setting a limit order right around there, and then you patiently wait for the price to retest it. Step 4, and listen, this is absolutely non-negotiable. You place your stop loss just outside the zone to define your risk. And finally, step 5, you set a logical target like a recent swing high or low where you expect sellers might jump in. Let's see this in action because it makes it so much clearer. On this Bitcoin chart, you can see a clear sideways consolidation phase. And then, bam, a powerful breakaway gap on huge volume. This move screamed new uptrend. Traders who spotted this could have planned an entry expecting more upside, and that is exactly what happened next. But what happens when a setup goes wrong? This is so critical. When a bullish fair value gap gets violated, meaning the price just slices right through it, that zone doesn't just vanish. No, it flips its role. It becomes what we call an inverse FVG. It transforms from a potential support area into a brand new resistance zone. And this can actually give you a whole new trade opportunity, a potential short entry if price comes back up to retest it from below.
Okay, look, a great setup is only half the battle. Your long-term success trading gaps, or really any pattern, is going to hinge entirely on mastering two things: your risk management and your own psychology.
You know, this quote just gets right to the heart of it. You can have the best, most perfect setup in the world, but if you don't have ironclad discipline to manage your risk and actually follow your own plan, it's totally worthless. This is the thing that separates consistently profitable traders from everyone else. So I want you to treat these as the absolute laws of trading. Rule number 1, always know your exit point with a stop loss before you even think about entering. 2, never risk too much of your capital on a single idea. 3, know where you plan to take profits. And maybe most importantly, if a setup doesn't perfectly fit your plan, you have to have the discipline to just walk away. The market will always be there tomorrow. And on the flip side of that coin is your psychological discipline. This is all about having the patience to wait for the price to come to your level instead of you chasing it. It means fighting off that incredibly powerful fear of missing out, that FOMO, when you see a huge gap happen without you. Let the market prove your idea is right, and then stick to your plan no matter what your emotions are screaming at you to do. All right, let's wrap this all up with the single most important mindset you have to adopt when you're trading gaps, or really any other pattern you find in the market. You have to burn this into your brain. A gap is a high probability clue about what the market might do next. It is not a crystal ball. It is never ever a guarantee. Your job isn't to predict the future. Your job is to execute a solid plan that has a statistical edge over and over and over again. And that kind of leads me to a final question for you. If you trade these patterns, what's your go-to approach? And more importantly, what is your number one non-negotiable role for managing your risk? Let us know what you think. Thanks for watching.